there's definitely been, can you say, over the last few years, a tendency or a trend in the hedge fund market that hedge funds have gone out and hired data hunters to find that next exciting data set that they should bring inside the organization and take advantage of in their alpha creation process. However, we have also seen in the last couple of years there's been a trend towards perhaps turning inside and say, why would we go out and hunt data if we already sit on big piles of content that could be potentially valuable? And what we are claiming, or what I will address today, is perhaps it's time for all of us to take a step and not just, can you say, the big organizations that are looking at their content. Perhaps it's time for all of us to see how can we monetize our own data. Every day, billions of digital information exchanges are taking place all over the world, and that also very much holds true within the asset management business. We're all constantly being bombarded by emails or instant messages from our external contacts or relationships, but also very much so from collaborators within our own organization. And this whole process generates vast amounts of information which are hard to digest, let alone turn into actionable insights. And adding to that, the diversity of the content we receive that could include anything from sell-side research reports to curated newsletters from industry experts, internal investment notes, or even news clippings only makes it harder to arrive at an investment decision. But the big question is really, does all of this internal information contain any value? And if so, does internal content, is that differentiated from what is already publicly available? Today, I want to share with you a real use case from a top fundamental hedge fund that have wanted to tap into their own internal content with the help of Ravenpack's text analytics engine. And like most other investors that we talk to, they of course also believe that they were sitting on a potential gold mine with their own information, and they weren't necessarily taking advantage of it. And in most cases, it's because it's hard to consume all of this textual content. If you are not a particularly tech-driven organization, you can't basically hire humans enough to read through all the emails that you receive. So they needed a systematic approach, and we came in to help them with that. And if we look at the fund in particular that we were working with here, and that we'll show the use case around, they are not different from many other fundamental hedge funds in the marketplace. They're fairly low-tech operation. They don't use any alternative data. They work mostly off spreadsheets, and they don't really apply any quant techniques. They have been successful, however, in managing a couple of funds. They have more than $1 billion under management, and they have been outperforming their respective benchmarks. They have been around for 7-8 years, and they're still fully employee-owned. They employ about 40 people, analysts that are specialized in energy, infrastructure, and transport, and they have operate a global mandate, but with a heavy European tilt. Even though they have been successful, taking more of a fundamental approach to their strategies, they have observed some alpha decay in recent years, and that is one of the things that triggered them into saying, okay, is there anything else we can do to continue performing well? And that was how this idea of internal content came up. So what did we do to help them? Well, first of all, of course, in order to analyze the data, we started collecting content. And we were able to collect 3 years of data in an anonymized fashion. And the content that we collected included files, emails, and instant messages, and we collected it on a 24/7 basis. We ran it through our analytical engine to enrich the content with sentiment, relevance, novelty, and also, of course, entity detection, so that they could associate it back to their trading universe. And using this content, the analytics we produced, we were able to create some simple daily sentiment factors, just looking at average sentiments across all of the various accounts and all of the content that was collected. And using these sentiment indicators, we tried to look at constructing a set of portfolios, ranking their universe according to the sentiment, and also provide potential weights for this. So if we look take a deeper step into the backtest that we performed, we looked at the universe that the fund was focused on, also with the hypothesis that part of the value that they might bring also comes from the employees that they had. So that we still believe that the fundamental process could add value even in our systematic approach to consuming the content, because we were relying on their analysts going out and curating the content to some extent that they were consuming, especially because they were a very sector-specific fund. They may, know what industry experts out there or newsletters you should subscribe to, and so on, in order to get valuable content that might not live in, in a traditional newswire or what you would consider a more broad public content. So we looked at about 180 publicly traded European companies within energy and infrastructure and transport. And as I mentioned, we were able to use an archive of up to 3 years worth of data. And the sentiment indicators we created were used to create long-only and to some extent long-short strategies if you also consider the hedges that we put in place. If we take a deeper look at the content that we collected, here we have showcased some volume numbers, and as you can see, most of the content came from email attachments, also the body of the email, but we also took in instant messages, both the attachments and the messages themselves. One of the things that I do want to highlight is that perhaps from a pure quality perspective, the data starts to become more reliable from early 2017, where Ravenpack began collecting the content ourselves in real time, as opposed to, loading some of the archives that were available. So what's interesting is, of course, what is really behind the signal? What is the type of stuff that we were able to detect from the content? Is there anything in the content that makes sense from a fundamental point of view? So we started looking into the types of events that we were detecting to see if it's events that make sense. And as we can see here, and by the way, just as a note, these are not novelty filtered. So if a particular, event type was covered a lot of time in the news, it would count here as well. And as we can see from this particular slide, a lot of the events that we were able to detect were associated with either products and services. So that could be product releases or product recalls or something like that. We also detected a lot of content around M&A activity, actually an astonishing amount of content. There was also, of course, more traditional content amongst the top 10 event groups that we detected, like earnings and analyst ratings, but we also saw something around equity actions amongst the top 5. So I think I think it makes sense. There seems to be some potential content here that, from a pure fundamental point of view, could be moving stock prices. If we look at it from a sentiment perspective, we could see that there was clearly a positive sentiment bias in the content, but it differs across the various event groups, where you could see perhaps something like analyst ratings were more balanced. And in fact, when we started analyzing the content and looking at marginal contributions, we could see that analyst ratings in particular was contributing to performance both on the long side as well as on the short side, where some of the other categories perhaps were contributing more to your buy signals just because there were more events available. So let's take a look take a deeper look at the actual backtest itself. So one of the things that we tried to do to understand the data better was to create these sentiment indicators and create both faster moving as well as slower moving indicators, which of course translated into different holding periods, or effective holding periods. And some of the things that what we found here, so basically the top panel, 1 to 120 in this case, measures the number of days that we use as the sentiment aggregation window. And we split up, can you say, the decisions, the signal into either long signals or positive sentiment signals, and into shorts, negative sentiment signals. And we also tried to compare it to a benchmark, a more public content or public news benchmark. So the blue lines here represent using news analytics, so public content. And the red lines here represents the signal that we were able to create from the fund's own internal data. And I think what was very interesting to see was that public news generally outperforms, can you say, the fund's own internal content in the short term, especially on the short side. So news tends to be very impactful when it's bad. But what we also found was it was decaying fairly quickly. Where, however, if you looked at internal content, the decay was much, much slower, especially on the long side. And that, of course, is very interesting for a long-only fundamentals shop that has longer holding periods in mind. So we find this very promising. And I think what's quite neat about this is as well that I think it shows some robustness because we are applying the exact same methodology on the internal content as we are to the public content that we know is useful. So we kind of take a step further and say, okay, this is interesting information. Let's try and dig a little deeper and try to create some portfolios from this. But if we look at, but before I go ahead and do that, if we look at, can you say, the types of events, the volume of events that we were able to detect, we actually found that 80% of all of the events that we were able to detect for their particular universe came from their internal content, and only 20% came from public news. And I think that showcases really the value of the information curation process that is taking place within the organization from their analysts. I will also say, however, that if you look at infrastructure and transportation and so on, it's probably not the most sexy industry, and it's not necessarily the industry which is most covered by public news wires. So for sure, in their particular use case, they were, can you say, really able to add value with 80% of all of the events detected. And as you saw before, and as I already highlighted, if we look at more public news content, we did see outperformance compared to the internal content, but it was for about the first week, after which, looking at these very simple signals, average sentiment signals, we saw it kind of decaying from that point onwards. It doesn't mean that there is not value or more value than what I'm showing here. We have taken a very simplistic approach, and simple approaches tends to be incorporated in prices fairly quickly. But if we looked at the positive sentiment signals, we found that the internal content held value up to a month out from an holding period perspective. And that, of course, was quite interesting. But as I also highlighted, the negative sentiment signals tended to go away fairly quickly. So in constructing a set of portfolios, we started applying some various restrictions. One of the things that we did was, because it's still a fundamental firm, we said, okay, we can't trade the full universe, so let's try and pick some of the more extreme sentiment stocks. We focus on the top 40. We also evaluated the top 20. There's still a fairly, can you say, targeted exposure within the top 40 because we sentiment weight. So we still tilt towards the more extreme sentiment stocks. I would say probably the top 20 names account for 70 or 80% of your allocations. And we focused on a 3-month look-back window to kind of target the slightly longer holding periods. We applied some illiquidity constraints or liquidity constraints. So we filtered out some of the most illiquid names in the universe that only accounted for 0.1% of AUM, so it's not a very restrictive filter. But we also applied some maximum allocation constraints, 10%, and also we required that we couldn't trade more than 10% over of the average daily volume over the last 21 days. And in terms of transaction costs, in our backtest, we applied 16% round-trip costs. And finally, we assumed $100 million in AUM, and as a benchmark, it was given to us to use MSCI Energy Transport and Infrastructure indices. So let's take a first look at some of the results here. So the blue line represents a pure long-only strategy. So of course we are naturally loading up on traditional factors here as well. So we try to apply some of the MSCI borrower risk models to say what could be attributed, what can we try to look at factor attribution here in the performance that we got. And what you can see here is the green line was what could be attributed to traditional factors, and of course, it's a quite big proportion, a proportion of the performance, of course, that can be explained by factors. But we still saw, and I think it is pretty clear here, that there is true alpha. There is alpha here that cannot be explained by traditional factors, and we found that to be very, very interesting. We also tried to look at it from relative to the benchmark, and we actually found that the benchmark that we were given weren't necessarily the best one. As you can see, if we just take a more passive, simple, perhaps a cheaper kind of hedge, and just say, let's do the excess return to the benchmark, we weren't really able to get rid of a lot of the volatility that was observed in the strategy, and in fact the benchmark hadn't performed particularly well, so a lot of it, can you say, stayed as P&L within the long-short strategy itself. Here, I basically just summarize some of the key results from the study. So if we take the pure long-only strategy, we're able to get an information ratio of 0.8. If we took the excess return to the benchmarks applied, we were able to increase that to about 1. However, if we assume a perfect hedge by can you say, looking at the factor attributions as the actual hedge portfolio, we were able to increase it to 1.6, which is of course quite attractive. And from an annualized return perspective, we were looking at about 6.5% per year. And in this particular case, you can see in terms of average holding periods, we're looking at 2 to 3 weeks. We are actually, if you're interested in seeing, can you say, more details on the particular study, we have released a new paper that kind of gives more insights that can be requested from our website. And we're also relaxing some of the assumptions that we're making, and I think what was quite interesting was when we started to say, okay, let's try and relax the liquidity constraint even further, saying, what if we trade into the signal over multiple days? We applied a 3-day period. That meant that we could build up larger portfolios, so we could go up to 30% in a single name. And of course, this is the fund was happy with this, also because they also trade dark pools, and we only look at exchange volume for restrictions. And what we found was that you actually got even better performance out of it by relaxing the liquidity constraint. So take a look at the paper if you're interested. So as concluding remarks before I open up for a few questions. although it's hard to determine the value of big data in accounting terms, it's very you can demonstrate value from an alpha perspective, and that's why working with these type of things in finance is interesting. And what we also found was that signals derived from the fund's internal big data provide value, and it captures something that doesn't seem to be available from public news sources. And I found that it was particularly interesting that we were able to find some fairly slow-moving, long or buy signals, as opposed to some of the stronger short signals that you would find in more public content. And I think it was also very interesting to see that the value held up after we were looking at factor attribution. So there seems to be, as I mentioned, true alpha available in your own content. Thank you very much. I'm happy to take questions if there are any. Otherwise, of course, there's lunch.
Hi, Peter. Thank you. That's very interesting. What's your interpretation of this result? So why do you think there is value in these internal emails and so forth? Do you think that they're just very good in filtering external news, or is it that, does value start or to be created from conversations between people?
I think there are multiple things that could be driving the signal. One is, as I highlighted already, the curation process that might be taking place, that they are able to get to content that we don't necessarily can get from public sources. I mean, from newswires, where they are able to figure out what experts out there with newsletters are interesting to follow. So I think that curation process, I think, is interesting. Also, of course, the analyst reports in here as well that doesn't necessarily live in public domain either, that you can get hold of as well, and that's also adding value. And plus the whole, collaborative effort within the organization itself. They are sharing internal investment notes and trade ideas and so on within the organization, and we are basically structuring that part here as well. But as it turns out, when we spoke to the fund, what we presented to them was outperforming their own signals. So it seems that taking a structured approach or looking at this as a mosaic, both from, the conversation that is taking place internally as well as the curated content that they bring in from outside, that kind of combination and normalization using our analytics was valuable. And I think this is, of course, a very simple signal. We also have started looking into trying to classify users to say which kind of users have the most valuable inboxes. And one of the things that came out without knowing, because it was anonymous for us, but we of course shared the results, and what was interesting that they came back with was the ones that we ranked low were more admin staff. So we got a lot of very intuitive kind of results out of when we started digging deeper into the marginal contributions of accounts and so on.
Yeah, time for one more question right in the back.
It seems to me that the parameter, which is the aggregation window of the sentiment signal, is a key parameter to this whole exercise. And I was just wondering how robust are the alpha results to the choice of that parameter? Because we don't know beforehand what's the best, right? So how would you choose it, and how robust is it? It's very easy to get it wrong.
Yeah, so in terms of the sentiment scoring, of course, we are applying our sentiment engines. So we are taking, it's something that works in public news, and I think, and we have shown here, it's also something that works with your own public content. And I think that shows some robustness. Of course, in terms of what should be, exactly the technique that we use, we haven't tried to fine-tune it much. We have tried to take the approaches that we would normally take with public content. So it's very, very simple. Just take an average of sentiment. Of course, that's a parameter. So I showed different kind of look-back windows. And that was just more to say, both from one day, which gave you value, but was a fast signal, And then, of course, you can extend the holding period to slow it down. Of course, it's something that you would select using cross-validation or something like that on an ongoing basis, or a step-forward approach or something like that. Or you just, can you say, have a pure in-sample, out-of-sample, and targeting the turnover that you want.
Peter, we are being asked if we can get access to the research.
Yes, the research paper is of course, providing more detail.
Great. Thank you, Peter, for
Thanks.
your talk.
This is Raven Pack.